If you have any questions for our support team, you can reach them in that chat now box. You can reach. Hey everyone, it's Rachel here with your Tech Talk Tuesday. With me today is David Blake to discuss the market rallies on the debt ceiling deal and some more information on the advanced decline line, one of his favorite technical indicators. David, how are you today?
I'm doing well, thank you.
Let's jump right in.
Okay. All right, we had a pretty good week in the market last week. We finally got the debt ceiling deal that took out some of the uncertainty that's been hanging over the market for a little while. So basically, the market letter we talked about, June kicked off on a high note. And we had some other, I mentioned almost like a trifecta of good news. We had also the Federal Reserve hinting that they're probably going to pause at the June FOMC meeting, which comes next Tuesday and Thursday. So we'll find out pretty soon about that. But as right now, it's only about a 20% probability, I believe, according to CME FedWatch, that they're going to hike rates a quarter point. But I think they're not going to be hinting that they're not going. They don't want to surprise the market. So I think they're, after sort of like 10 in a row of hiking rates, at some point you got to stop and let's see what's going to happen. Now, surprisingly, last week. And it's probably a good thing that the Fed did hint that they were going to pause, because on Friday we got the jobs report that came in and showed 300+ thousand new jobs added to payrolls in May, which was about 100-some thousand more than what we thought. We also had on Thursday the ADP employment report also showed a big jump in payrolls, which surprised the market. I think if they had not been hinting that they were going to hold the rates at where they currently are, I think you would have probably had a pretty good sell-off on that. But as it is, if they're going to pause in here, the market took that as, okay, well, this is obviously we're probably going to have, there's a less chance of a recession coming in. That's what sent the indexes up sharply higher. The Dow, I think, was up around 700 points. That was the best day it's had since, I think, January 3rd or 4th, when it had like a 701 point hike. And that was when Powell also had hinted that they were possibly going to stop hiking rates in that. So like I say, next week we have the FOMC meeting. I think it's around a 20-22% chance right now that probability that they'll raise rates at a quarter point. I think they're going to, and the market does too. I think they're going to hold steady here and give a couple more weeks to see what happens in July. Now, unfortunately, July they actually it's about a coin toss, I believe, at the CME FedWatch group, whether they're going to raise rates again or not. I think that'll be dependent on the data that comes in, especially with the jobs. We did see, despite the jump in payrolls, we did see the unemployment rate jump from 3.4 to 3.7, which was the right direction. That probably also helped, the market rally off of that. I think the Fed would like to see us get above 4.25, 4.5 on the unemployment rate to show that the market's slowing down. We also saw a broadening out of the different indexes, which of the underlying breadth, which was a big plus for the market going forward. I want to talk a little bit more of that later, but we had defensive sectors, utilities, and consumer staples were basically the laggards, although I think every sector finished positive last week. But the defensive sectors, they were only up marginally. And then we had pretty nice gains in consumer discretionary, materials, REITs, industrials, and healthcare. Again, that's spreading things out. This has been a very narrow rally where we basically saw the gains in the big cap tech and also the communication services. That type of, those two sectors have been really was pushing this market up to higher and higher here, and a 13-month high, I think, on the NASDAQ. And we also have the S&P 500 now approaching its August 2022 high, which is it's a big deal for the market, because that's represented a pretty big resistance level going forward here. Also, as we ended May, we noticed that the Dow Jones and the Russell 2000 actually finished lower for that month, and they actually were the ones that were leading the market higher on Friday. And that's something that we've talked about in past tech talks and all, that we want to see the rest of the market catch up to the NASDAQ. That's just broadening out, that we want to see more participation. We don't want to see the same 7 or 8 or 10 stocks, pulling the market up higher, because that, one of them runs into a roadblock, and that's just going to exasperate the selling on the downside. So the fact that we're spreading out a little bit was a nice sign for it. We also saw a little bit of a bump higher in rates on Friday, which because of the jobs thing, but that was not too bad. We're at 3.7 on the 10-year, 4.5 on the 2-year. I think those came down just a smidgen on yesterday. Today they're a little changed also. I think the market's pretty happy right now where we are. They want to make sure, they just want to see what happens next Tuesday and Wednesday when the FOMC meeting concludes. So another thing I noticed last week was that as we rotated into more cyclical stocks, the Dow Jones, the S&P 500, and the NASDAQ, they were all higher last week for the first time in about 3 weeks. NASDAQ, I think, has been on a 6-week tear, but the fact that all of them were advanced is a little bit different. That shows some broader underlying strength. So we did see some improvement in the technical condition of the market last week. The technical indicators are in bullish ground now. We have the MACD, which kind of measures the short-term trend, is strong. 14-day RSI is strong, but it did show. You often look at the momentum indicator on the RSI. Once it gets above 70, it's considered an overbought market, and we actually saw the NASDAQ and NASDAQ 100 and the semiconductor index finish above the 70 range. So they were all overbought, and in fact, the NASDAQ 100, which includes all the big cap tech stocks, it was the most overbought on the 14-day RSI since November of 2021. And of course, that's when the NASDAQ and NASDAQ 100 topped out back then. So that's something. I mentioned that when you get that overbought, you're probably going to see some choppy trading and some consolidation. At least you hope you do. You don't want to see this thing just keep on becoming more overbought. Now, with saying that, when a stock or an index becomes overbought, it can stay overbought for a while. You just don't want to see it, the RSIs get up to 70, above 75. I think they were 74 or something like that on Friday. And then also we had stochastics are up around 95, something like that. So that's something we want to keep an eye on also. We talked about the Dow Jones moving lower in May, while the NASDAQ moved higher. That was the most divergence between those two indicators in almost 30 years, or more than 30 years. The NASDAQ was up something like 9%. The Dow was down something like 3 or 4%. So that's a rarity. That just shows you how much, how narrow this rally was. Again, 30 plus years since they've diverged like that. So that's something we wanted to see, start to correct itself. Of course, that's going to mean some choppy consolidation in the NASDAQ, while the Dow and small caps and S&P 500 catch up a little bit. And if that happens for the next month or so, that's fine. We'll be starting to move into the second quarter earnings at the end of June. So we've got about another 5-6 weeks here where the market can kind of, consolidate and see what's going to happen here, whether we're going to have start to get cuts in the earnings as if the economy slows down, or whether the cuts are going to be, not so bad, and maybe not even get a cut. Maybe we can stay the same. That could keep the market where we are. We also saw the major averages trade back above some key moving average resistance levels. The Dow Jones broke back above its 50 and 100-day moving average last week, and then we also saw the small cap Russell 2000 and Dow Jones Transportation Index, which again have been showing negative divergence for weeks. They were able to cross back above resistance at their 50 and 200-day moving averages, although they both remain below their 100-day moving average. But I think if we can, can consolidate in here a little bit, we should see them be able to move above that, hopefully. All right, we also saw the S&P 500 kind of break out of its trading range around 4,200, 4,225 or so, about a week or so ago. And that opened up the possibility for the S&P 500 to get to around the 4,300, 4,325. That was our short-term target that we put in the market letter last week. That kind of represents, I believe it's the August high, I think. I have to look at the chart. I'm sorry about that. But anyway, that would represent a 61. If we get to 43.25, that would represent a 61.8% retracement of the January 2022 to October 2022 sell-off. And that also coincides with the April 2022 high. So we'll see if we can get through that 43.25 on the S&P 500. I think it's going to be a kind of a tough nut to get through, but we'll see what happens as the market, if the underlying breadth kind of spreads out. We also have the NASDAQ, which it's already retraced 50% of its bear market sell-off. It peaked last November of 2021. So it's a little bit long of its bear market. But if it retraces gets up to that 61.8% retracement, like what we're looking for in the S&P 500, that brings around 13.9 in the for the NASDAQ. But that brings that into play, which would be about another let's see, we're around 13.3 right now, so another 500-600 points on the NASDAQ. And of course, if we can get a broadening out of the different stocks in the NASDAQ, which includes a lot of small cap and healthcare and financials, especially a lot of financials in the NASDAQ, that would really help that come out. And the Dow Jones is trading just below. The Dow Jones actually hit its 61.8% retracement a while ago, and then it's been trading sideways for several months since the first of the year. But its target would come in around 33.9, 33.950 is what we would look to get up there. That represents about another 400 points in the Dow Jones from where we are. Okay, I mentioned that again, the underlying breadth was a concern, and if this rally was going to be sustainable, we would need to see that underlying breadth broaden out. When I talk about that, you talk about I talk about the advanced decline lines going the opposite direction of the pricing of the indexes, and also how the new highs and new lows are also negative, which is again negative divergence in these things. So these are indicators that I talk about often, and maybe we can take a look at them in there. But I wrapped it up last week and said that we had a trifecta basically of uncertainty that was removed from the market, and it's possible that if the economic data stays fairly strong, we could actually maybe even get a little bit of a summer rally. Goldman Sachs came out this morning, and they see only about a 25% chance of the economy falling into recovery, and they're not sure that they're going to need to cut earnings levels for the second quarter or the third quarter as much as previously thought. But then again, of course, you have Morgan Stanley came out yesterday, and they still see they think that earnings could probably fall 15-16% over the next 2 quarters as the economy slows. So there's some divergent opinions on where the economy is going to go from here by the 2 big broker dealers. So we'll have to see on that. But again, it looks like right now I think that the market is starting. That was a real welcome relief that we saw last week, where we had the Dow and the small caps outperform everything else. And I think that at this stage, until we get some more economic data and going into next week, what I would like to see would be the NASDAQ kind of turning sideways, and maybe the Dow Jones and the Russell 2000 start to outperform.
Great. Well, you mentioned how narrow the recent rally has been, that 7 to 10 stocks have provided most of the gains. Can we look at some charts that would show what you mean by narrow breadth and what negative divergence is in different charts?
Yeah, Rachel, let's go on the home page. I want you to click on the right-hand column over there where it says Market Recap. We update this. If you don't look at this, this will give you kind of a snapshot of what's going on. It gives you a quick chart of all the different indicators. But let's move down the page a little bit here. And you're going to see why this rally in the NASDAQ was worrisome. I mean, you just read the headlines and you go, holy cow, the NASDAQ's up 1% every day. It's up 7% in May. My God, the market's going to go to new highs. Okay, well, first off, let's look at the NASDAQ AD line over here. Okay, since this goes back to February, when I believe that was one of the highs for this year, NASDAQ's been working higher. Well, look at this line, this NASDAQ. You can draw trend lines, not on these charts, but you can actually do them with yourself. But if this is not a broad rally in the market with this NASDAQ AD line. As you can see, it's going from 355,000 units all the way down to minus 370,000 units. So that just shows you more and more stocks that are under distribution as the market was going up. And then even over on the NYSE advanced decline line, the same thing. You really had a drop off back there in March when we had a big drop. Then we kind of bounced back. But then for the last, since the 1st of April, it's been declining also. And in fact, I think I wrote a couple of weeks ago that the AD line, even with this rally on Friday and Monday and stuff, we're still below where we were in April. When the market was going down. So we've got a lot of stocks under distribution. And when you look at things like this, these are things that when we talk about negative divergence, you want to see. We consider the AD lines to be leading indicators of market direction. And that's kind of been the rules and one of the rules of technical analysis. And then when you see negative divergence or positive divergence, now positive divergence would be if we saw the NASDAQ AD line going up, yet we saw the NASDAQ price going down, then the AD line would be showing positive divergence. And that's showing you that even though the market's selling off, most of the stocks are under distribution, which is a bullish sign, which means that at some point we're going to catch up. So as you can see here, when you look at these things and you start to see this negative divergence, it should make you a bit cautious and concerned. Now, at the end of the day, price is what matters, but you want to see how you got there. Now, the other thing is over here, if you look at this NASDAQ and also in the NYSE, the new highs, new lows, just below that, the AD line charts, you can see that for months, we're making more new lows than new highs. Now, just in the last week or so, we saw that narrow. And in fact, we finally saw last week, Monday and this past Friday, we saw 2 days in a row of the NASDAQ making more new highs and new lows. That happened, mid-May for 3 days. But as far as the whole week goes, I don't think the NASDAQ has had more new highs in a week than new lows since sometime last November, when we saw the thing flip around real quick. We started bouncing off the lows. So that's something that you want to see. Another thing I want to go to, let's go to the charts for a second, Rachel. And I want you to, first of all, go ahead and put in SPY. And this is a SPDR ETF. Okay. As you can see on this, what you'll see is you actually see the SPDR, or the S&P 500, actually making higher lows. And also with this breakout here last week, as we approach the August 2022 high, breaking out again, making new highs. So we're hoping to see this thing. Hopefully, we're not going to see failure at this thing at the August highs. Hopefully, we can break that thing out. But that's a bullish pattern when you're making higher highs and higher lows. Now, I want you to, on the comparison thing next to that, I want you to put in RSP. Now this is the RSP is another ETF, and this is the equal weighted S&P 500. And as you can see on this chart, the underperformance of that just since well, this is going back several years, but just looking at this, you can see how the equal weight has actually been kind of drifting lower here since especially since April, as the SPY, which has the SPY S&P 500 is weighted differently. The higher cap stocks have a higher weighting than some of the smaller caps. But then on the equal weighted one, they're all the same. If you have 500 stocks, they each count as a point per day. So as you can see the divergence on this thing, which is another thing you want to watch. Let's get rid of of both of these just for a second. And then I want you to put the RSP back into the first box. Okay, this is the equal weighted one again. Go up to the top there and click on trend line, and then go to the top up here in February. I want you to draw a trend line from that thing there all the way down through these last couple of peaks in the RSP over here. Exactly. Yeah, go on down, just touch the top of those. There you go. Perfect. Now, as you can see on Friday, that we broke through a pretty significant trend line. The more times that trend line touches, stocks come up to that trend line, the more resistance, the stronger that is. So when we do break through that, it's more of a sign. On the bad part, although we usually use the simple moving average, the 200-day moving average, exponential, which keeps the moving averages a little bit more front forward. The equal weighted S&P 500 did stall out or run into resistance at that level. However, today we're up a little bit more. We're still struggling below that, but we did break through that downward trending line, and that's bullish for the S&P 500. But we still need to get above that, even the 200-day EMA. I think it's. Let me check something on my charts on the simple. Yeah, we did break above the simple moving average 200-day, but the EMA it's still struggling just below that. So we want to see a little bit more. I'd like to see this thing maybe at least get up to the break out and get up to the highs that we saw sometime in May on that. But this is a chart that shows you that the underlying stocks are starting to broaden out with the rally because the equal weight now is starting to break out. Another thing I wanted to look at real briefly, some of the times if we're going to see the broader market catch up to the to the leaders, a lot of times you can take a look at the some of the different sectors. Let's go with XLB. This is the materials, which of course is more as a cyclical sector. And again, if you draw the trend line from that high back there in February and bring it down along those tops, you're going to see that we right now the XLB, which is lagged the tech and all that kind of stuff. You can see where we're just in the process of breaking above that, above that downward trend line. A break above that, again, shows you we're starting to see strength in some of the cyclicals. We're starting to see the different the coppers, the steel, that type of thing, the things that are going to help the economy expand. That's showing you that is, if it breaks out above that, that will be good for the broader market. Let's take a look at XLI the same way. Here's the industrials. Okay, you can see this thing kind of going sideways. Again, it kind of peaked a little bit later over here. If you draw a trend line, you have to come in around March. But you can kind of come down here and see some failed resistance. But then on Friday, again with the XLI, you broke above. Well, actually, you'd bring your trend line down a little bit lower. As you can see on Friday, okay, industrials also are breaking above that descending trend line. Again, this is what you want to see. You don't want to see these things, coming up and stalling out at those levels. So you got materials, you got industrials starting to are starting to break out of the resistance levels. And if we can keep on seeing this now, again, these are the first signs that the underlying breadth started to broaden out, which we need for this market to move higher. If these things are going to fail here and they start going below these key moving average support levels again, right now most of them have climbed back above their 250-day moving averages. We want to see that hold those levels. If we have a sell-off in these days where we get some bad news or something happens, you can go in here and check. You just want to take a look to see if they're holding support. As long as they're holding support, then the technical condition of the market is good enough where you can kind of be nibbling away here, and you can, maybe perhaps see if we're going to maybe even get ourselves a little bit of a summer rally. I think until we get through next week, anything you do in the market, I think it's probably best just to, if it's something that you like, maybe you nibble a little bit on it. I wouldn't buy any full positions on last Friday's, big move in that. But I think if you see a little bit of a pullback and we hold support, you can start to nibble away, and we'll see what happens. Again, it's very possible. Historically, it won't. But if we can sidestep a recession, the consumer is still flush with cash, which is going to find its way going back in. If we start to see rates, maybe I don't think we're going to see a decline in rates or a rate cut later this year. Of course, that can change. The other thing that you want to watch is if you start to see spikes in any of the data that we're watching. We've been surprised by the jobs report. We look at the initial jobless claims for several weeks. We came in and we talked about we need to get above 200,000. We need to get above 220,000. Okay, now we're up there around 250,000. What you want to watch is, which will be a little bit worrisome, is all of a sudden if you read about all the layoffs, but we're not quite seeing that yet. I think I read recently where part of that is because it took some of these companies so long to hire people that they're reluctant to actually let them go. They're announcing, say we're going to probably have to lay people off, but they're reluctant to do it because it took so long to find people to fill the jobs to get them back to work. So, but if we come in here and we start to see a spike in like initial jobless claims, where all of a sudden you jump up around 350, something like that, or 300 plus, or if you see something where you see some of the consumer price index or the PPI all of a sudden drop way down, and you see some of this economic data we fall back in below 50, where all of a sudden it looks like the economy is slowing down more than what they're hoping for. Then you might struggle a little bit. You might see the market start to sell off again. But as of right now, the signs are starting to get a little bit better, and the prices we're starting to see firm up a little bit. I still think I would still be cautious because, again, this inflation is proving to be a little stickier than what the Federal Reserve hopes for. But in the perfect world, which is maybe what the market's starting to price in, you're seeing that the hike in rates is slowing things down just enough that we'll start to see inflation come down, and we'll have to see what happens here over the next probably 4 to 6 weeks. Let's get through the FOMC meeting, and then we'll have to start to see as we get towards the end of June, when they start to either that's when you start to see some of the companies begin to announce earnings that they're going to come up a little short or something like that. So it's going to be a little kind of interesting in the next couple weeks. No need to rush into everything. I don't see this market going to new highs anytime soon. But just be cautious. And again, as you see the market broaden out, it's a positive for everything going forward.
Wonderful. Well, thank you so much, David, for being with us today and explaining all of that to us. If you are interested in using MarketEdge or trying it out, we have a 2-week free trial. Go ahead and sign up at MarketEdge.com. If you have any questions for David or anyone on the MarketEdge team, feel free to reach out by sending us an email to support@MarketEdge.com or clicking that handy dandy box in the bottom right corner that says leave us a message. Otherwise, we'll talk to you guys later. Thanks so much.